Hello and welcome to today's video. My name is Eric and today we're going to be talking about why a trader might decide to use a debit spread as opposed to using just straight puts or calls in a trade setup. So this trade happened today and it was a perfect example of why a debit spread saved us from exiting the trade early. This was the day after Amazon announced earnings. And as you would expect, there was a little bit of movement in the stock. In this opening of the stock on Amazon, it hit a high of 273.88 and a low somewhere down around 255.56. And we, of course, wanted to put a trade on to take advantage of this volatility, but we didn't want to, one, pay a high premium because of the volatility in the options. Premiums were probably exaggerated. But we still, again, wanted to take advantage of the volatility or the movement in here. And so we decided to use a debit spread instead of a straight call. In this case, we were doing a call debit spread, so our bias was still bullish. We opened up this debit spread buying the 262.50 call and selling the 265 call, and we paid $1 or $100 per spread. Now, when we opened this, the price was trading somewhere around in this range, about 263 to 265. And after we opened it, price continued to move lower and dropped all the way down to somewhere in the 256 range. Now, had we purchased a single contract, the option chain with the same expiration date of May 15th, we would have spent somewhere in the neighborhood of about $7.50 or $750 per call. Now, had we done that and price continued to move lower, we would have had to endure down a drawdown of about $3 or a low of about $380. So we would have literally lost about half of our $750 had we done straight put or call. But because we did a debit spread and we only spent $100, our debit spread went to a low of about $88. And so, again, using that debit spread, which, as a reminder, we're buying one option, one call, and selling one call. We bought the 62.50 call and sold the 265, and that's what created our lower barrier to entry, and two, mitigated a lot of the downside when the trade worked against us before it started to move up. Now, as of the filming of this, the option contracts that we purchased, price moved higher and was trading somewhere around 265, 266. Position was up about 45% on the day. We'll probably close it out tomorrow in anticipation that price is going to move higher. But again, the point of using a debit spread is to be able to mitigate volatility that happens when you buy options and to give us a chance to watch price move down and up without having to necessarily weather a substantial loss and take the heat of losing 50% of the value of your option in the process of having a bias that price is going to move higher. Click on the link below if you'd like to learn more about debit spreads and trading options.